Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 23rd of April, 2026. Tech drove markets to fresh record highs last night, despite the ongoing Hormuz closure. I think I sort of said over the course of the last few podcasts that basically the market's really moved on, and probably doesn't really care now. Market's not listening to Trump's crap anymore. They're sort of just blocked it out of their minds. And I think there's been a few, decent sort of, utility shifts around using natural gas in the US, and I think we are now very much focused on earnings here at the moment, and essentially until we start to see those inflation numbers and consumer, retail sales and consumer confidence numbers in the coming months. This probably sticks around here at some stage, or at some sort of levels. Apple made a bit of a bounce back last night. So did Broadcom. Micron's still on a tear. AMD. So all of those really good quality, positive names that were going gangbusters before this ridiculous conflict started. We're really back to, in particular, the critical minerals and things like that as well. But anything around those high conviction themes, the data center build out, the critical minerals and the sort of play, etc., are all going really well, like power and copper, etc. Software's still a little bit beaten down. We had a pretty disappointing guidance from ServiceNow last night. I was kind of pretty hopeful on that one, and we had a couple of recommendations out here yesterday at MPC in the Global Alpha, which ServiceNow was one of those. But what it reflects is it's maybe a little bit early, and there's still a little bit of uncertainty around that software thematic, and we'll probably have to wait at least another quarter to see those the numbers come through. But it's it. I mean, there was still a beat on the top and the bottom lines, and subscriptions went really well, etc. But we'll have to wait a little bit to see that the SaaS apocalypse investment thesis be really debunked. It's been debunked in the earnings, and you can probably forgive the software a software CEO for being a little bit conservative on guidance, just in case. But look, I think it'll, overall, the fact that earnings didn't drop is a very good sign in the long run. So the other one was Lam Research, which is a sort of chip fabricator. It did very well. It was up 3% into earnings, and then a good sort of 3 or 4% after that as well. GE Vernova was another one we were looking at in that power, the power generation area. They also do, not just nuclear and SMR, but they've got, natural gas stuff as well. But they were up 14%, and it's a relatively low beta. Well, it's not a high octane stock. So that's an extraordinary result for them overall. We're really, those earnings results were broadly very positive, as it stands at the minute. So another one of our previous high conviction picks, Intuitive Surgical's done quite well. I mean, as you can see, index is up. We're up a couple of percent for the week. Technicals fairly the same. It's all tech driven, which is why we're sort of down in these other markets here. And the Dow was barely eked out anything. But it very much concentrated in that S&P and Nasdaq. In terms of commodities, crude's still up. We're in terms of crude, we're still around that 93 mark. But as I said, the market's ignoring it as it stands at the moment. We had a bit of a relief rally because it was a bit of risk on, and it seems to be for some reason that gold, silver, and platinum are risk on assets these days. Started to head a little bit higher. Coal was a little bit higher as well. Uranium just on an absolute tear, up 7% last night. That uranium ETF. Bitcoin actually making a bit of a comeback as well. We're what are we in Bitcoin there? We're nearing 80,000, but positive showing this week. And all of this is despite the fact that the US dollar's up about 0.5% this week as well. So in terms of earnings, just a very quick summary. Tesla beat on top and bottom lines, and it was when EPS adjusted, it beat on top and bottom lines. Margins recovered to be pretty significantly higher than what analysts were expecting. And we're up around about 4% in the aftermarket in Tesla until they announced their capex numbers, which were around about the which were significantly higher than what the market was expecting at 25 billion, and then we saw the stock come off about 6 or 7%. Service now. Subscription revenue grew 19%, beating top end of the guidance in total revenue, and essentially, customers have grown 130% year on year. The company is well on track to exceed its 1 billion in that now AEST target in 2026. And then they raised the full year subscription guidance, but it was below market expectations. So the stock got hammered. It was about 15% or something. I think it's, I dare say we're seeing this in the likes of, CSL and some of the healthcare stocks like Cochlear yesterday, and some of these software names, WiseTech a couple of weeks ago. It's that final bit of bad news or just something that's just really broken the back of some of these investors, and then they've capitulated. If you have a look at the likes of WiseTech, etc., they've since come back up again. So, it's a pretty noisy market these days, and you've got to sort of stick to your convictions, and not be mucking around, or either stick to your discipline if you don't have high conviction, or stick to your conviction. In these things, and not watch the day-to-day noise, because otherwise you're essentially going to get faked out of positions, because the market just tends to move a lot more and overextend at the bottoms and tops of ranges than it ever has in history in the 30 years I've ever seen. So it's kind of it's isolated volatility within a lower volatility broader index. So it feels more important than what it actually is in the scheme of things. GE Vernova, look, they absolutely smashed consensus. We basically, the stock, like I said, was up around about 17%. The backlog surged to 163 billion, and they had a 200 billion backlog targeted. They've actually pulled that forward to 2027. They pulled it forward a full year. Electrification orders jumped 86% year on year, and the power segment shipped 25 gas turbines, up 35% year on year. And with margins expanding as well on that. So look, free cash flow well exceeded the full year expectations, and they're going to they've revised upwards. And Lam Research as well, record third consecutive revenue record. EPS well beat the top end of the guidance, there's a bunch of other sort of technical numbers in there that I won't bore you with, but basically that's grinding higher. And as you can sort of see, Tesla, because it's extraordinarily expensive and it's got so many different businesses going on within the business, was is why it was probably a little bit sensitive at this point of the range. And they've got a lot of new products coming out. I think the big thing that drove it up early was the cyber semi trailer truck. Apparently they've had orders of 10,000, particularly with diesel prices where they are. I dare say the orders might go up again. But it was a pretty boring report. But importantly, all of those manufacturing and release headlines for Cybercab, cyber semi, and Optimus were all on track. Which Elon's got a notorious habit of over promising and under delivering on timelines. The Tesla energy part as well, their margins jumped from about 15 to 21%, and that's because he's got that they're starting to really pump out those batteries now in the and make a lot of their own stuff. So they actually saw their materials cost drop and their margins expand. So the car business is doing okay. And obviously, once you get self-driving, the semis, the Cybercab, and Optimus going, I mean, it'll be a completely different company next year. I'm still very bullish on it. ServiceNow, I think, just like I said, software sector. There's still some nerves and capitulation happening in that sector, but these the AI thematic in terms of needing power and needing chips is alive and well, and we've got the positive ones on the right hand side of the screen there. That really does probably change our focus a little bit for the earnings leading ahead. We'll probably just be watching the software names and probably more so looking at these picks and shovels plays in the power and the chips and the fab, etc., and the memory. They've been ever reliable, and you just want to play into that momentum. I think overall, probably won't play in Intel, but Microsoft's been quite low. People would be expecting a rise in that one. I think that this software as a service thing is probably, like I said, still got one, maybe at maximum 2 quarterly earnings for this to iron itself out. The cream will come to the top. The rest will float off into the distance, and I'd probably flag that as still slightly too high risk as it stands at the moment. But Intel will probably wait and see. It probably will report quite well, I would imagine. But it's just got a history of disappointing. It's a bit of it's like the chip manufacturer's like simple cousin essentially is Intel, and probably wouldn't have survived had it not been the only manufacturer in the States. Next era energy probably mightn't do too badly as well, and I think they'll be keenly watch the ExxonMobil on Friday as well. So so overall, this is really lining up quite good for our buy the dip strategy. You're going to get you got that midterm election, highly reliable dip between May and October. It happens to beyond 10%. Every year, every midterm year, which is every 4 years since 1940. So we're talking, 86 odd years. And we're sitting at record highs at the moment. So for those of you who've got ETFs or index ETFs at the moment, this thing's capital efficient. You've got to put down a fifth of the capital to have the same exposure. So you can, it's a great play here on the seasonality where you can sell out of your existing ETFs. Index ETFs at record highs in the S&P or the Nasdaq, for instance. You can put a fifth of that cash into buy the dip and get the same exposure, and you're going to get the lowest Monday close of the 6 months between May 18th and October 18th, where on average you're going to get around about a 17% better fill on the buy side. And then it plays out over 3 years. It's just maths, people. It's everyone knows the index. It's designed to go up. Failing companies get replaced by successful ones. It's one of the more reliable trades. But don't be doing it in a 1-to-1 exposure, paying management fees to an ETF provider. Be smart with your money and do it through buy the dip. So this thing's available to wholesale and retail investors. Scan the QR code there and get involved. And you'll have some extra capital left over to deploy in whatever you want as well. So, get on board that one. That really wraps things up for today. ASX is probably going to be slightly off. I mean, it was mainly tech-based. So, have a great day, people, and we will speak again tomorrow.
Feeling lost with investing? Meet Mosaic. Mosaic is MPC Markets' platform that turns confusing markets into clear, actionable guidance for your portfolio. Discover Mosaic today. Portfolio and trade ideas in one place for clients and subscribers, powered by MPC Markets.